Great, everyone. It's 10 o'clock. Let's get going. So thanks, everyone, for joining. The key things, really, that I want to discuss today is that, really, what we're seeing is very much a bit of some very mixed markets, I would say. I don't think there's any unifying themes at the moment. But one thing we are tending to see is actually risks do fairly well as we move towards the end of the year. So we've got a lot of event risk out there still, that is for sure. But there are some tentative signs, maybe, of a Santa rally going on in the market. So it's definitely worth... it's certainly interesting out there. We are oscillating a little bit, but the euro, for example, is at its highs nearly of the day. The dollar is very, very weak across the board. The yen is more mixed, as is the pound. Swissy, very weak. CAD, mixed. Ahead of that Bank of Canada meeting, which I'll talk to you about in a bit. And then we've also got the Aussie and Kiwi doing incredibly well. We've had a real strong performance there from the Aussie. It's up nearly 0.5% against the dollar today, which I'll talk about in a minute. But the key thing, the first thing I want to just go through is euro dollar. I know that there's, a lot of interest in euro dollar. A lot of people are saying, will we rally into year end? I know I've asked you guys a lot of questions about this. It's quite hard. It is quite a hard question to answer at the moment. Purely because we've got a lot of event risk, let me just move that out of the way. We've got an awful lot of event risk, what with things going on with Eurozone finance ministers meetings. Spain seems to be out of the picture for now. We've also got, we also had a slightly better growth picture from Spain yesterday, from the Eurozone in its entirety yesterday. And added to that, we also have some slightly better, we do also have the ECB meeting, so that's another key thing to watch out for this week. But just looking at it now, as you can see, this is the daily chart. Nice break higher above 130 there. We're above the whole cluster of daily moving averages, so there's an awful lot of support on the way down. Quite bullish. Heading up, though, towards, we are fast approaching this key resistance level here, this double top, around about that 130-170 mark. That is going to be a key level. And even though we're constructive on euro dollar, it could get thwarted at this level. And if we get a triple top here and we fall lower, then that 128.70 level, where all of these cluster of moving averages lie, they're going to be incredibly, we think they're going to be act as good support. So yes, we're constructive. Yes, things look good, but upside may be limited if we can't get above this level. Now, what do we need to really push us above this level? Well, we probably need the dollar to give us a bit of a hand, actually, because remember, it's not just all about the euro. The dollar weakened yesterday, or continued to weaken today after weakening yesterday, largely on the back of some very weak data coming out of the US, so that weak ism. So you may have heard about that, you may have even watched it. Why does that matter for the FX markets? Well, the reason why it matters is because next week we get the FOMC meeting on the 12th, which I believe is, Friday's the 7th, 8th, 9th, 10th, 11th, 12th, I think that's Wednesday. Yes, I believe it is. So next Wednesday we get the FOMC meeting. This is going to be a real big deal, largely because we've got, it's when Operation Twist ends. So Operation Twist was put in place about a year ago. It's going to roll off, and whether or not they're going to expand QE3. Some people have even been calling it QE4. If we get more signs that the US economy is very, very weak, it really puts the pressure on the Fed to enact more stimulus next week, and that is why it's important. That's why it's worth looking at the fundamentals this week. We've got a lot out. We had manufacturing yesterday. It fell into contraction zone for November. We've got services sector data out tomorrow. We've got a whole swathe of data. Of course, we've got that non-farm payrolls report on Friday. Absolutely pivotal. If we see a rise in the unemployment rate, some very weak jobs growth. Remember as well, the November data could be hard to read on the back of Hurricane Sandy. But any sign of weakness is really going to put a lot of pressure on the FOMC to act. Also, you know, it's their last meeting of the year. It's the last meeting before we reach that fiscal cliff edge. There's still no deal on that. The FOMC may decide to do a bit of preemptive, QE or preemptive extension of QE3. To make sure that there's absolutely no tightening, that monetary policy is as accommodative as it can be. Now, if that happens, bringing it back to euro dollar, if that does happen, and they are very, very dovish, they do announce an extension of QE3, which is what the market expects, remember. We would still expect a knee-jerk reaction higher in the euro, purely because we think this Thursday, just the relative monetary stances by the ECB, who are doing nothing, they're doing no accommodative monetary policy at all. We don't expect them to enact anything new this Thursday, compared with the Fed, who are willing to keep on throwing the kitchen sink at this crisis, really does show that really should mean that the yield differential is in the UK's favour. So again, as we move towards next Wednesday's meeting, we may continue to see upward pressure on the euro, but we think it's going to be a big fundamental driver that really gets us above there. Obviously we need, potentially stabilisation not only in the eurozone now, but also in with fiscal cliff negotiations, etc. There is another thing I want to show you quickly. Another main reason why, another factor to consider when trading the euro at the moment, and why it's moved so high, and whether or not we can get above this 1.30-1.75 level, which again, as you may have noticed from our tone, we think there's probably a chance that it may stall around there, and that's because of this. Here we go. Now you should be able to see, this is the Spanish 10-year bond yield chart. The reason why I'm showing it to you is not something that retail traders tend to trade, but it's really worth having a look at them, and even if you don't have Bloomberg like I do, you can still hear all about them, and about falling bond yields, etc., etc. It's written in the press pretty much on a daily basis. But as you can see here, we're all the way back at levels that we've last been in March. That really suggests a major reduction in credit risk in Spain. Remember, fourth largest economy, big problem. People were talking about it having to accept bailout requests, etc., etc. Since July, since the ECB head Draghi turned around and said that things should be good or they'll stand behind it but support the single currency. We've seen such a massive decline in credit risk, but what's really got it going during kind of mid-November or since middle of November, which has coincided with that move higher in the euro, has been a few things. Number one, news that Greece was going to get was getting its next bailout money. Number two, that there's been some progress on making Greece's debt burden sustainable. And the number three, yesterday we heard it from Merkel herself that she may be willing to write off some of Greece's debt. This is all very positive, especially the bond buyback for Greece, which some of you may have heard of. Basically, Greece is going to buy back its own bonds at a cheap level. However, it does suggest that those punters, if you like, have been buying Greek debt in the hope that they would make a buck on it. They are going to, basically, and that's probably being fed into, and that's also being fed into good news about Spain too. So a lot of easing of pressure of credit risk in Spain, which is coinciding, as you can see there. I'll show you the two of them move inversely to each other, but really coinciding with that move higher in the euro, in the euro dollar there, and they both seem to kind of peak and bottom at the same time. The other thing that I would just point out though is that and we're writing our quarterly outlook now for the for the first quarter of 2013, and what's interesting about this is that we really have a lot of, there's a lot of event risk out there for next year. The markets may not be concentrating on it this year, but Spain has to issue its largest ever amount of debt next year, and that's going to be really pivotal. So we're a bit concerned that there's not that much further for Spanish bond yields to go, even if they drift back to that 5% mark, it may coincide with them hitting support down there and us hitting resistance, and euro dollar hitting resistance at that 1.30-1.75 level. So I do think that's going to be a really hard level to get over. Now let me just move that out of the way. So with euro dollar, as you can see, you know, very, very good support. Obviously from where we are now, 129.90, huge level. That is the daily Ichimoku cloud top. So we are above that, so we are constructive, so it does suggest we're in a technical uptrend. There are a lot of positive technical signals, but as you can see, there's still this massive level of resistance. So even if the technical signals are saying at the moment, yeah, things are bullish, we're in an uptrend, we could still get thwarted. So I think we're going to see a lot of profit taking on the way up from here, and we may slow down on the gains. So do watch out for that. Obviously 130.80 on the way up to that 130.170 level is also acting as fairly good support, along with, as we would expect, 130.40. So do watch out for that too. The other thing I want to tell you, as I said, the Bank of Canada today has been in the news for not for its policy action, but for the fact that its governor is going to become the governor of the Bank of England. Which is good news. He's very well respected, but basically he holds a meeting today. So it's not one of his last ones because he still has another couple to do, but he's still got to do them till June. But basically, no rate changes expected. But what we've seen in dollar CAD, let's just go into the hourly here. As you can see, it's drifted lower over the last couple of days. It really has, or over the last week, sorry. You know, we've seen the dollar CAD just kind of moderate with overall pressure, but then it did start to, you know, it did kind of bottom around about that 99.10 level and bounce from there. Hasn't really been able to make much traction. And actually, if you look at it, it's been really trading sideways. Let me just bring it up on the other charts as well, just so you can see it slightly clearer than what you can see it right now. So let's take a look here. So as you can see, dollar CAD had broken above the daily Ichimoku cloud. The CAD was very weak. The dollar was very, very strong. However, we got above parity, and then since then it's been kind of moving lower again. If we do get, now there is a chance that the Bank of Canada, even though they aren't expected to hike interest rates or anything like that, interest rates are expected to remain on hold at 1%, they may move lower. We may see dollar CAD come under pressure if the Bank of Canada is hawkish. That's what we're looking at now, is whether or not their comments are hawkish. Remember, not that long ago, the Bank of Canada was the first of the major central banks to be expected to hike interest rates in the first quarter of 2013. Now that's been pushed out, and we don't think they're going to hike in the first quarter of 2013 at all. That's one of the reasons why we've seen since mid-September this downward pressure on the CAD, so upward pressure on the US dollar. However, there is a chance that they're not going to be as complacent. They're not necessarily going to follow the Aussie or the RBA, because there are some issues. Credit growth, for example, quite high in Canada, so they're not going to want to kind of cut interest rates and maybe spark bubbles down the line. We've also seen a few more. We've also seen quite a few more. Slightly more hawkish comments. Growth has been okay. It's been fine in Canada. Just a few things to point out. Bear with me a moment. You know, we've had fairly good. Inflation doesn't really seem to be a problem, but it did move higher slightly. We also saw GDP for September. That was not as good as expected. It kind of fell. So we've seen a bit of mixed economic data coming out, but house prices are still quite high, and so is credit growth. So that's kind of the key thing there to watch. So we think they may be slightly more hawkish than some other central banks. So that could basically further weigh on dollar CAD, but there is very good support just below 99 at 98.85. Now that is the top of this daily Ichimoku cloud here, as you can see. So that's certainly something worth looking at there. If we get below there again, it's just the end of the uptrend, which would suggest more of a drift lower, potentially back to that 98 mark in the medium term. So do watch out for that. If we get a stable environment whereby the dollar continues to get sold off, then we should see the CAD be able to regain control. Not only is it one of the riskier end of the FX spectrum, but it's also one of the particularly sensitive to. It's also particularly sensitive to changes in risk sentiment, etc., etc. So do watch out for that. Now, I did promise to show you the Aussie as well. Let's just use my other chart quickly. Hang on. Because the Aussie is kind of the opposite of what the CAD is doing at the moment. We've actually seen the RBA cut interest rates today. So this is the hourly chart on the Aussie. Cut interest rates, you say, well, look at that. The Aussie has gone higher. This is just a regular Aussie dollar chart. So we've seen the Aussie dollar really hold very, very good support ahead of 104 and really move higher on the back of this. Now, it's not quite at that 104.90 high. That's the resistance level that we're targeting now, this 104.90 level. And let me just go, it's quite a stiff level of resistance in the short term. A couple of things. So why, some people will ask, well, why is the Aussie rallying when they actually cut interest rates? Well, the reason why, or one of the reasons why for sure, is that or one of the reasons why anyway, is that, there was a lot of this cut was well expected, it was well flagged. There's a chance that they may not cut going forward. The statement of accompanying the cut actually said there were some signs of a pickup in the domestic economy. The external economy, China seems to be growing quite stronger after that manufacturing PMI data. Added to that, we've also seen, some overall positive movement. We've seen, some positive data, certainly on the housing front, etc., etc. So, we're not saying that the Aussie has turned a corner by no means, but that's also helped to fuel this move in Aussie dollar. Will it be enough to get us above this 104.90 level? Well, we're going to have to see a bit of pricing out of interest rate expectations, even more. Interest rate cut expectations. A lot of people are expecting further cuts from the RBA, and I think that could limit strength going forward. So that means that rather than moving up in a straight line, we might meander higher. Added to that, the Aussie is also that's the interest rate differentials are one thing that moved the Aussie. And right now, after the RBA cut, whereby they weren't as dovish looking out to the future, that's working on the Aussie side. But the other thing you've got to look at is the risk environment. Now, yes, the Aussie's been doing very well because we've seen risk sentiment come back into the market. But remember, risk sentiment very, very fragile at the moment. If we get some more negative news coming out of the fiscal cliff in the US, then we could fall back. Very, very good support in the short term, certainly at this 104.25 level, a big cluster of hourly moving averages. But then we look kind of at the 103 level. Now, as we move towards the end of the year, we think that we could trade between 103, or 103.20 say, which also corresponds with a 200-day moving average, and then this 106 level. Now, if we get above 104.90, which is this high from kind of last week, then we may have a real chance at those the highs from the last 6 months really at 106. So that's the level that we're targeting. Those of you who followed our Q4 outlook will know that we looked between a move for parity and 106. Well, we didn't really get back to parity in October and November, but 106 does seem to be kind of maybe a step too far for this pair, purely because there is still the chance the RBA can be very, very sensitive to what goes on. They can change their view. Someone's just asked me if our Q1 report for 2013, is it available to the public or subscription only? Very much completely available to the public. It's published on our website. It won't be published till late next week though, so probably look for it around about the 14th of December on the research page of the forex.com website. You can also find it on Yahoo Finance, and maybe even FX Street post a part of it. So if you just kind of maybe type it into Google or go on our forex.com website, then in the next couple of weeks you should be able to find it on there. It will be on the research page, quite predominant, so you should be able to find that. That's a good thing to do, to look for. The other thing the other cross that we're looking at is euro sterling. Funny that you should mention our quarterly. That's something that we've been looking at as well. Just looking at it here, as you can see, euro sterling again had a really nice move higher, nice clean line up there, really nice trending line up there, running into a bit of resistance here though, as would be normal around about the 200-day moving average. That comes in around 81. 10 to 20, and that is exactly kind of where we've been left here. We are currently trading exactly on that 200-day moving average. And remember, when you get above a 200-day moving average, that can be a very, very bullish signal. So, no wonder that investors are taking a bit of profit here. The pound has been doing incredibly well. We're going to look at that later. But certainly with euro sterling, there are some positive signs. We got above the top of the daily Ichimoku cloud. That comes in at 80.65. Now that's going to be very, very good support. Remember, anything above the cloud considered a technical uptrend. But we really need to get above this kind of 81.20 level to really make a stab at, 82.50, but maybe even then towards 83 as we start the new year. That would be kind of the key thing that we would show you. Now, euro sterling, obviously it's moving. It's very sensitive to overall risk sentiment and also things going on in the eurozone. So if we continue to see the euro move higher, then that could be what pushes euro sterling above this key 81.20 level, because above there really opens the way to 83 in the medium term, maybe towards the end of the year. As I said, very much still in a technical uptrend, and things are. There is a lot of positive sentiment on the back of this for now. Our concern with the pound, which I'll look at now, is that it may sell off tomorrow on the back of the Chancellor's pre-budget statement. A lot of it is expected. We've seen this huge jump forward in the pound today. It's been able to brush off quite weak economic data coming from the construction sector. It's close to its highs for kind of nearly a month now, and it looks good now. What we've seen really over the last kind of 3-4 months is it start to sell off when it gets to any kind of when it approaches that 162 level, and we do think that between kind of 161.50 and 162 we could get a bit of a sell-off in the cable. And the reason why, let's go down to a slightly shorter term time frame. We are starting to move into a slightly overbought territory here, as you can see. That may limit the upside to about that 160 level. We've really broken out of our, we've been on a really nice trend, but then that kind of move higher the last couple of days is really quite unusual, so we might slow down from here. Added to that, just in the last 2 days, we've broken above the top of our Ichimoku daily cloud. That's 160.65. That is now very, very good support. So there's very good support on the way down. We just feel that, what with the Chancellor's statement tomorrow, and the Bank of England meeting, yes, the bank isn't expected to do anything. So basically, that will be kind of, not too much of an impact, we don't think. But what we may see is the Chancellor's statement spook the markets out a little bit more, and that would be because, if he goes against his own fiscal consolidation plans, for example, that may hurt things. So do watch out for that. So again, as I said, 160.65 on the downside. Added to that, we also have on the upside, as I said, 162 we would expect 162 to act as a very, very tough resistance zone. Obviously before that though, 161. 40 to 50, that should act as a very tough resistance zone, certainly in the short term. So do watch out for that. As I said, very good support, 161.10, just slightly below where we are now, and also, as I said, that 160.65 level on a more slightly longer term basis. So expect a bit of volatility tomorrow around about the time of the Chancellor's autumn statement, which takes place at 12:30. If we manage to or if he speaks the markets in any way, we know that we expect growth to be revised down. We also expect, the debt outlook to be made, also to have deteriorated and to be targets to be pushed out. That could all weigh on the pound. And while it may not change the overall kind of mini uptrend that we're seeing, or certainly recovery that we've been seeing since November, it may certainly just put the brakes on it for a little while and precipitate some or cause some profit taking around about 161.40, and if we do get above that 161.50 level, then potentially around about that 162 zone. That was a very tough level of resistance there in October, November time, so we would watch out for that. Now the other thing I wanted to show you was gold quickly. as you can see with gold, it's really come off quite sharply. That's been quite interesting because gold right now, it's a real liquidity trade. It's not really acting as anything else. We're seeing stocks move higher. We've seen FX be a bit more mixed, but gold has come off. Gold has just really struggled to rally. It's moving kind of sideways, and I think that's largely because there's a bigger risk of deflation at the moment than there is of inflation. Maybe also, let's look at it, from the start of this year. So here's kind of the start of 2012. If you'd bought at the start of 2012, you bought kind of at the low at 1550, then you've made, even though it's been a bumpy ride, you've made quite a lot of money, so you maybe want to just square up your position. Very, very good support around about this 1680 level, the 200-day moving average. Then below there, we'd probably look towards that kind of maybe 1600 or 1650 levels, certainly to start with. My problem with gold, I don't necessarily think it's going to fall off a cliff, but I do see it being range bound. I think it will attract buyers around about that 1650 to 80 mark, and I think people are still willing to sell it at 1750. Right now, it seems to me like 1800 for now as in from now until the end of the year, is going to be just one step too far for this cross. It's a triple top, as you can see here. 1, 2, well, nearly 2, 3, and there's obviously a huge amount of selling pressure. The bulls don't have control; they're not willing to push it through this level, and that's why we keep falling off. So people want to keep their hand into gold, but they're not willing to push it into a paradigm above here, and that's because we think the reason why is that fiscal cliff fears. Gold does tend to be one of the first movers in the markets. It really does suffer when there's fear or uncertainty in the markets, as there is now with the fiscal cliff. Growth hasn't been fantastic. When you see weak growth, especially in an economy like when you see weak growth, that suggests kind of deflation. Now, potentially what we may see as we move towards that FOMC meeting, my caveat to my kind of slightly weakish gold scenario is QE3 is an extension of QE3 to try and make up for the end of Operation Twist by the FOMC. So we've got to wait for next week. But gold really has been the ultimate QE3 trade. You can see that move higher from 1600 all the way to 1800 was fueled by QE expectations. Since then, we've come down. It's interesting because it's actually been moving a lot with the dollar rather than moving outside of the dollar. And we think that's just at the moment is largely just to do with it's quite difficult. We think that will probably turn at some point, but I think that right now the gold price is suffering a bit on the back of fiscal cliff fears. The thing that could turn this around is what happens to the FOMC. At that point, we would expect, if they are very, very accommodative, they do suggest quite an aggressive alternative to Operation Twist, with more bond purchases, which extends QE3 quite a lot, which remember is an unending round of stimulus. Then what we may see is a bit of a turnaround here with gold moving higher and the dollar moving lower. So that's about it from me. If anyone's got a question, I'm happy to answer it. Just let me know. I tried to cover quite a good mix. So if you could just ask the question, you can ask it either in your Q&A box. I know a lot of you use your chat box, so that's fine. I think that's about it then. It doesn't seem like I've got any questions from you guys. Hopefully you've all been pleased by that. Now, those of you who, again, as I said, you will get our Q1 outlook. That will be available on our website from next week. So do watch out for that. Also do check our website every now and then. We're also on Twitter on Forex.com. That's another... that is also worth checking in if you do have a Twitter feed and you do like to look at your Forex news. We update things. We also post links to our research on there, so that's quite a good thing to follow. And do watch out for that ECB meeting. We don't expect any changes, but it could cause a bit of volatility. Likewise, the Chancellor's statement tomorrow could see a bit of selling pressure on the pound. So good luck, everyone, trading this week. Glad you enjoyed it, and please do join us next week